Hello, everyone. Welcome to today's Compass Tax Educators webinar. I'm Cheryl Chavato. Today's webinar is Federal Disasters, What You Need to Know. And our speaker is Thomas Gorzinski. Tom is the Senior Tax Consultant for Gorzinski & Associates. He's an enrolled agent, a U.S. tax court practitioner, certified tax planner, and he holds an MS in taxation from Golden Gate University. And he was awarded the 2019 Excellence in Education Award from NAEA. And Tom, it's yours.
Thank you, Cheryl, and welcome everybody to today's webinar. I think this is a very timely topic, not just because, unfortunately, of the disasters that happened in the past year, specifically in the southeastern United States, but we're seeing more and more areas getting federal tax relief from disasters, and they could be as small as a county or as large as several states. And when that trigger happens, there are certain things under the tax law that occur, and we need to be knowledgeable about them for our clients. And so in today's course, we're going to pick on three areas. There's actually several different things that are triggered when a federal disaster is declared, but we're going to focus on tax deadline postponements because we see, again, this more and more. We're going to talk about qualified disaster distributions, which actually, this is a new provision from Secure 2.0, and it allows special tax treatment for someone who resides in a disaster area. And then we're going to review casualty losses simply because folks in a disaster area often have that happen and are able to potentially claim a loss on their tax return. So again, those are going to be the three focuses, and we are going to talk about some other issues at the end very briefly, specifically involuntary conversions, estimated tax penalty relief, and disaster relief payments that are non-taxable to individuals. So before we kind of dive into those topics, I just want to kind of set the stage for what are we looking at when it comes to a disaster. The Stafford Act, which is a federal law, is what governs disaster management at the federal level. And the president has the authority to designate an incident as either an emergency or a major disaster. And we're going to see that most of the things that get relief in the tax code are declared as major disasters. Now, when something is declared as an emergency or disaster, it gets a FEMA number. And so when you're working with clients who are in a disaster zone, it's important to know the FEMA number for the incident that occurred, because some of the tax forms will require that you enter that information, for example. So it's important to have it handy. And as you can see, an emergency has EM as the prefix. A major disaster has DR as the prefix. And there's two terms also that I think are important to know because they're sometimes used in the tax law. The first one is incident period. And that's simply the time span during which whatever caused the disaster occurs. So there's no fixed time for this. It depends on what's going on the ground. The declaration date is the date the president designates the incident as either an emergency or a major disaster. So for today's class, we picked one particular disaster. And then what we did was applied an example in each of the areas to that particular disaster. So we selected the Hawaii wildfires that occurred in the Maui area in August of 2023. And so as you can see, when you go to the FEMA website, there's a graphic with respect to this, which has the disaster, the FEMA number, the incident period, and the declaration date. So the FEMA website does have all of that information readily available if you go there for a client who has a particular issue. So the first thing we're going to talk about today are postponements. So postponements are very, very common, and you'll actually see The IRS releases, I would say, almost dozens of them now each year. And some of the changes to Code Section 7508A that has happened in the last couple of years have made that possible and have made that as an option for the IRS. So it's important to realize, and I think this is something we're still kind of figuring out, under the code section, there's actually two types of postponements. So the first one is automatic, okay? And so an automatic postponement occurs when a disaster is declared. And that automatic postponement is 60 days. So no matter what the IRS does or does not do, the tax law gives every taxpayer in an affected area in a disaster zone a automatic 60-day postponement. The IRS does not have to act in that case. There's a second one. It's a discretionary postponement. So the IRS can choose to postpone deadlines further for a particular disaster. And that's up to 1 year based on IRS action. So they have to actually affirmatively do something. So we have a 60-day automatic postponement that occurs when a disaster is declared. And then we have a discretionary that the IRS can issue and postpone actions up to 1 year. So the discretionary adds to the 60 days and can't remove anything from it. And this actually was from a tax court case in the last year where the tax court invalidated part of the regulations for this code section because they said the statute was clear. The 60-day postponement is automatic and applies to this list of items, and the IRS cannot alter that list of items. If they choose to provide additional relief under their discretionary power, they can. Now, these periods, again, can run concurrently to each other, and they also run concurrently with any extension. So if you have an extension on file, the postponement can run concurrent to that. So let's talk about the 60-day trigger. The trigger is generally a major disaster declaration, and it begins on the earlier of the incident date specified, and then it ends about 60 days later after the latest incident date. So again, we're looking at the incident date here. The covered taxpayers are very specific for the 60-day postponement, and the whole list is in your materials, along with the citations to everything. But generally, the most common taxpayer is going to be the principal residence in the area, or the principal place of business is in the area. Those are going to be the two most common triggers for that automatic 60-day. The 60-day has only covers a certain number of covered acts: return filing, payment of tax, tax court petition, a refund claim, things along those lines. Those are covered by the automatic 60 days. Now, in most disaster declarations, I would say almost all, but that I don't want to over exaggerate it. The IRS provides discretionary relief. They add to the 60 days. And now for their 1 year discretionary power, it's actually beyond a major disaster. They can also do it for a so-called significant fire. They also can do it for terroristic or military actions. And we saw the IRS do that recently with the Israel-Gaza postponements. After the October 7th attacks, they've now issued 2 notices postponing up to their maximum authority of a year tax-related actions in Israel, the West Bank, and Gaza. So I think that's the first time we've seen that for a terroristic or military action. The covered taxpayers, in the regulation, it lists who is considered a covered taxpayer. Again, this looks very similar. Principal residence, principal place of business, necessary records for certain tax acts are located there. But notice the last line: any other person specified in guidance. So the key is to read the guidance for that specific disaster. You have to take a look at it. Same thing with the covered acts. You have to look at the IRS guidance, but almost always it's going to include anything in the Treasury regulation that's cited there and Rev Proc 2018-58. That Rev Proc has over 120 pages of postponed tax actions. So it really, a disaster postponement, the discretionary one that the IRS can do, can cover hundreds of different tax actions. And Cheryl, I think it's time for our first poll question.
Indeed it is. What is the code section 7508A mandatory postponement period? 60 days, 90 days, or 1 year? And if you're watching this on demand, use this as the opportunity to review the material. Tom, the best answer?
It's 60 days for the automatic postponement.
Thank you.
So we're going to dive into the Hawaii example that we talked about earlier. And I'm going to actually pull up the IRS's specific guidance so I can show you what I'm talking about with some of these principles. So the first thing I want you to know is that when a disaster happens, they generally issue two press releases. One, it starts with IR, and then the other starts with the two-letter nomenclature for that particular state, in this case, HI. The IR general press release gives you a broad overview of the postponement actions, and it's really for general public consumption. But the HI, or state-specific release, is where we as tax professionals want to know. That's the gold. That's where all of the details live. So whenever there's a postponement, I always go to the state-specific press release, because that gives you all of the details that we need to know as tax professionals. And sometimes that comes a few days after the other one. This postponement was granted all the way to February 15th, 2024. And so if someone's an affected taxpayer, and they don't have to actually be impacted by the disaster to be affected, that's a term of art that's used in the code. If a required action fell on any date on or after August 8th of 23, which is the date the disaster began, and before February 15th of 24, anything that falls within that period, they have until February 15th of 24 to complete that action. So it's important to recognize what is that time period. And so these are snippets from the Hawaii specific guidance. So covered disaster area, it says the localities listed above are entitled to the relief. So you want to look above, because it's going to be county by county usually, and it will state which counties whoever can get relief in that particular county. And again, if a county is listed, they have to be an affected taxpayer for that county, which in most circumstances mean that's their primary residence, their principal place of business is there, or their records necessary to comply with a tax action are located there. The second is who is affected. And it will say specifically those taxpayers listed in that Treasury reg. And that's the list that we talked about earlier. So that whole list, it's in your materials, it's on the slide. They are automatically affected taxpayers. Now, if anybody else is added, it will be listed there. So one thing, for example, with the Gaza and Israel postponement, they listed tax preparers specifically. Now, tax professionals in a disaster zone, their clients don't automatically get a postponement unless you can show that the taxpayer's records to complete an act required under the tax law are with the professional in the zone. But in the Gaza-Israel postponement, it specifically said if the client has a tax preparer in the disaster zone. So again, always read the affected taxpayer provision to see who is covered. And then it also says they give affected taxpayers until February 15th to perform time-sensitive actions. Now, look how they describe it. They reference that regulation, which we discussed earlier, and that Rev Proc, which we discussed earlier. So really anything listed in that regulation or in the Rev Proc, and the Rev Proc is hundreds of pages long, is potentially postponed. So anytime we get a question, is insert action postponed by the disaster provision, you have to go to the revenue procedure to see if it's in there. Now, if you look at the second piece, and I bring this up for a very specific reason, because there are some things that are not covered, and they usually will call them out. So in there, it says, unless an act is specifically listed in the Rev Proc, the postponement of time to file and pay does not apply to information returns in W-2, 1094, et cetera, et cetera, et cetera. So it says right there, W-2s, 1099s, that time is not postponed. It also says employment and excise tax deposits are not postponed, but it does give some limited penalty relief. So again, it's so important. Read the specific notice to see what relief is granted. My experience is that payroll tax deposits are rarely given a full postponement. Often they're given a narrow time frame that you can catch up by with penalty relief. So we're going to say our client is Pablo. His principal residence is in Maui County. So he's an affected taxpayer. He doesn't have to demonstrate he actually was impacted, because the fact that his principal residence is there automatically makes him an affected taxpayer. And let's say he's self-employed, he was on extension, and the return was due October 15th, 2023. And let's say he also was required to make quarterly estimates. So what would have happened is that extended return deadline of October 15th, 23 was postponed to February 15th of 24. Now, the payment deadline was before the disaster. That was not affected. Quarterly payments that fall in that period, which were the third and fourth quarters of 23, were postponed till February 15th of 24. Didn't have to make those quarterlies until then. If they had a SEP, if Pablo had a SEP, that's actually listed in the revenue procedure. It's one of those in 100 plus pages of documents. He's actually could make the contribution till February 15th of 24. So again, that revenue procedure is key. If you ever have a question, pull it up and do a keyword search to try and look for the relevant provision that's there. The second thing we're going to talk about today are qualified disaster recovery distributions. The IRS also calls these qualified disaster distributions, as we're going to see, but this is the code term for them. This was added by Secure 2.0. So this is, again, a relatively new provision in the law, and it's available for all types of retirement plans. So IRAs, 401ks are able to take advantage of this provision. And they're available, again, generally when a disaster is declared. And you'll see in the press release that the IRS publishes, it sometimes will list other disaster relief provisions that are applicable to taxpayers. And so you'll often see this distribution rule mentioned there. Now, before this existed, Congress used to do a kind of disaster by disaster provision for retirement distributions related to a disaster zone. I think we all remember coronavirus related distributions in 2020. And when we get into this, you're going to see a lot of familiar features from coronavirus related distributions that are now a permanent part of the tax code. They are reported on Form 8915F. Now, for a while, they were doing every year like A, B, C, D, but F is it. They said F is final. They're not going to do a G or H. We're going to stick with F. Cheryl, I think it's time for a poll question.
It is. The IRS's postponement for the Hawaii wildfires, HI 202305, allowed affected taxpayers to complete eligible tax-related actions by what date? December 31st, 2023, February 15th, 2024, or April 15th, 2024. And Tom, the correct answer.
February 15th, 2024.
Thank you.
Thank you, Cheryl. To get a qualified disaster distribution, there are two requirements. First, you have to do it within a specified time frame. So it's a time-limited opportunity to take advantage of this. And second, it has to be made to somebody if the principal place of abode is in the disaster area. And then they also have to sustain an economic loss due to the disaster. And we're going to discuss what that means in a second. The maximum amount you can treat as a qualified disaster distribution is $22,000. And let me be clear, per disaster. So if you have multiple disasters in one particular geographic location, you can do $22,000 for each one if the taxpayer meets those requirements: principal place of abode and sustaining an economic loss due to that disaster. Now, this amount, unfortunately, is not adjusted for inflation. We'll see what happens. So first, let's talk about the period. So it's generally the date the disaster begins, and it ends 179 days after whichever is the latest of on the screen. So we're generally going to be looking at the disaster beginning date or the disaster declaration date. We take the later of them, and then we look 179 days later. Now, there's a nifty calendar feature in the public, either in, I think in the form instructions for 8915F, that basically says if this was the date of the latest of the dates, here's the last date you have to take a distribution. I'm going to show you the nifty calendar in our example. Now, December 9th, 2022 is listed there because Congress wanted to allow people who had disasters before the enactment of Secure 2.0 a limited time to take out distributions for those prior disasters. That period, of course, has ended, but it was possible for disasters in 21 and 22 for those taxpayers who maybe have taken a qualified disaster distribution under this provision during 2023, even though it was several years later. Now, the question always comes down to what is an economic loss? And here the rules are very taxpayer friendly. The loss amount does not have to correspond to the distribution amount. So if you can show any amount of loss, $10, $50, $5,000, you can take a distribution up to $22,000. And that was a similar rule to the coronavirus related distributions, if you remember back in those days. And we don't really have solid guidance on economic loss. All we really have are the form instructions, and they give some examples: damage to real property, displacement from the home, or loss of livelihood due to temporary or permanent layoff. So you missed a couple days of work, economic loss. You had to evacuate and had costs incurred. That's an economic loss. You had damage to your property and you had to pay at least something towards it due to a deductible. That's an economic loss. So there's a lot of ways to show economic loss so that they can take advantage of this provision. There are three main tax benefits to a qualified disaster distribution: no 10% tax, no 10% penalty on early withdrawals. Second, that the default is to spread the income equally over 3 tax years. So you get to spread the tax impact out. Now you can elect to include it in the year of the distribution if you so choose. And the third is you can repay it. Now the repayment is 3 years from the day after the date of receipt. So you have to know when the taxpayer actually received the money. You go the day after that, and then you add 3 years. Of course, Congress has to make the provision a little bit more complicated, or maybe the IRS did. in its interpretation, but that's the rule. The 3-year repayment period is a really beneficial option. And as we're going to learn in Secure 2.0, Congress is making more and more of these 10% penalty exceptions eligible for repayment. It's a new kick that Congress has decided to get onto. Now, once you make the election to include the entire amount in income, you have to do that election on a timely filed return, including extensions. We're going to show you where to make the election because it's really hidden on the form. So we're going to show you the form, and it's a checkbox that's kind of buried on the form. Now, once you make it, you can't revoke it. You potentially can change it on a superseding return. You could potentially do it on an amended return filed within 6 months of the due date there's a general relief provision for statutory extensions in that period. And there's more information in the citation in the text on that. So a couple of things on the repayment provision. Again, if you remember the coronavirus-related distribution rules, this should sound familiar. And the repayment provisions are administered by the IRS in a way that's very taxpayer friendly. So there are planning opportunities, I believe, here with how this is handled if the taxpayer wants to repay it. So first, any amounts repaid are treated as a trustee-to-trustee transfer and are not taxable. Second, if you repay an amount to the retirement account, you include it on the next filed 8915F. So it's based on when you file these returns. So if I repay it and I haven't filed my upcoming return yet, then my repayment is credited on the next return that I file on that year's 8915F. Now, if I repay more than the installment on my next 8915F, the excess, I have a choice. I can carry it forward to the next year if there is a repayment in a future year, or I can carry it back. So that's where the planning opportunity is. Do I get a bigger benefit to carry it back and get a refund there? Or do I get a bigger tax benefit to carry it forward and reduce my tax in a future year? And I can also choose the carryback year. So if there's multiple options for a carryback, I can choose which one to carry it back to. So very taxpayer-friendly provision. So Joseph's primary residence was in Maui County, Hawaii, and his business was closed for 4 days to the fires. Why did I mention the business was closed 4 days? Economic loss. Because we have to show that Joseph had an economic loss in order to potentially take advantage of these provisions. So we're going to say on December 21st, 2023, he withdrew $23,500 from his IRA, had no non-deductible contributions, and he just used the money for savings and personal expenses. And again, didn't use it for disaster-related reasons, right? And he received the check on December 28th of 2023. So we know that potentially 22,000 of that can be a qualified disaster distribution, but 1,500 of it is not. And so we'll have to treat that separately. So this is the handy dandy calendar I was talking about that's in the form instructions. So if you wanted to know the last date that he could take a qualified disaster distribution, you just go to the later of the two relevant dates and you kind of just look over to the right and it tells you the last date to make the distribution. So in that case for Joseph, it's February 15th, 2024. Now, by default, with no elections, he spreads the income equally over 3 years for the 22,000. In the first year, though, he also has that 1,500 that does not qualify, that has to be included in income in 23. That's why the 23 number is higher. He has the 10% penalty on the 23 return on the 1500 unless another penalty exception applies. He's going to have to include the 8915F in every tax year, 23, 24, 25, to report each of the 3 installments. And he'll file Form 5329 in 23 because of the $1,500, because he's either going to pay the 10% penalty or exclude it under another provision. And he can repay all or some of the $22,000 by December 29th, 2026. Remember, he received it on December 28th of 23. We have the next day and then 3 years, and that's how we get to that date. And before we go with the rest of the example, I think we have a poll question to answer.
We do. What is the maximum amount that can be treated as a qualified disaster recovery distribution per disaster? $10,000, $15,000, or $22,000? And Tom, what's the answer?
$22,000.
Thank you.
So here's the form. And if you look in the materials in the appendix, I actually included the entire form there for your reference. You'll see the $22,000, 1/3 of it is included in income. Pretty straightforward on the form. But again, the entire form is in the appendix. Now, Joseph can elect to include the entire amount in 2023. So if he does, he has $23,500 of income in 23. But again, he'll only pay the 10% penalty on $1,500. He'll only have to complete the 8915F in 23, and he still has the same time frame to repay those amounts. Now, why would Joseph do this? It's ultimately kind of a decision on what potentially could save more tax. So we look at the time value of money with distributing the tax over a couple of years, what we think those rates are going to look like versus including it all in this year. And so again, anytime the tax law gives us a choice, it's a planning opportunity. So the form looks pretty basic because it all is going to say $22,000 because he's electing to include it all in income in this year. But I put this in a box because it's so easy to miss. That checkbox is the election, and it's kind of buried in line 22 of part 3. There's no separate statement. It's just a checkbox that you need to check if you want to include all of the money as income in 1 year. So let's say Joseph spreads the $22,000 over 3 years, and he repays $9,000 before he files the 2024 1040. Okay, so that's going to be more than the amount that he has to include on that return. So the $73.33 he normally would include on the 24 return goes to 0. Okay. Now there's a difference, $1,667. 2 options: carry it forward to the 25, carry it back to the 23, and file an amended return, which of course is a lot of work relative to simply carrying it forward. So you have to, again, cost benefit analysis of this. If you carry it back, the amended form has to include the repayment amount, and there's very specific language that you put. It says 1,667 excess repayment from 2024 Form 8915F, 2023 disasters. And that language is directly from the instructions. And if you want to take a look at that more, there's a citation in the materials. Casualty losses is going to be our third major topic for today. So you can claim a loss from losses from fire, storm, shipwreck, or other casualty or theft. Now, I'm not going to get into the weeds here, but a casualty is a sudden, unexpected event. It's not termite damage that's happened over many years, such as progressive deterioration, right? And so first we have to determine, does it qualify? Of course, if there's a disaster, it's very likely that any loss is due to a fire, storm, or other casualty. Now, you normally take the loss the year it's sustained. So my house is destroyed, my car is destroyed. In this year, I take it. But you can't take it if there is a claim outstanding for compensation, if there's a reasonable prospect of recovery. So it's possible that you may take it several years later when that reasonable prospect of recovery has ended. So just be aware that just because they suffered or sustained a loss, they may have to wait until there's no reasonable prospect of recovery. Now, unfortunately, the Tax Cuts and Jobs Act did a number on personal casualty losses. It said they're only deductible if it's attributed to a federally declared disaster. Now, also, you can claim them to the extent of personal casualty gains. So what's a personal casualty gain? So if I get, for example, an insurance reimbursement due to a casualty and it exceeds my basis in that item, that's a gain. I can always use losses to the extent of a gain when it comes to a personal casualty. Okay. Now, this provision is temporary through 2025. I don't know what's going to happen with it. We'll have to see what happens next year with whatever potential tax legislation there is. Now, you can have a casualty loss attributed to a trade or business activity or an activity engaged in for profit, and you don't need to declare disaster to claim the loss. The declared disaster limitation only applies to personal casualty losses. So how do you calculate it? It's the lesser of the adjusted basis for determining loss on the sale of the property, or the decrease in the fair market value of the property. So you need to have an idea of what the fair market value was before the casualty and after the casualty, so you can fill in that formula. Now, ideally, there's an appraisal to establish a property's fair market value before and after. Now, the regulations also say, though, that you can look at the repair costs necessary to restore the property, and that can be evidence of the decrease in the fair market value. But ultimately, the larger the deduction you claim, the more I would want more concrete data points in order to substantiate that deduction. Now, of course, you're in a casualty zone. So, some of these things are difficult to do, and I understand that. But again, the larger the loss, the more I want to dot the I's and cross the T's with my substantiation in case it's ever questioned. Now, of course, if you get compensation of any kind, or if there's any salvage value to the property, you can't claim an amount for a loss amount. It's reduced by those amounts. So the loss amount could be reduced. Now, once you've determined your loss amount, you have to actually go through a couple more hurdles before you can claim that actual deduction. The first is you have to reduce $100 from each casualty event that occurred during the year. Don't ask me why. It's $100. It's a pain in the neck, but it is what it is. Okay. So the first thing is you reduce each casualty event by $100. Second, you add all of the casualty losses for a year, and they're only allowed to the extent they exceed the sum of, again, personal casualty gains and 10% of the taxpayer's AGI. So we have a 10% AGI threshold we have to meet. And if the loss exceeds that, that's the amount that we can claim on the return. Now, it's an itemized deduction on Schedule A for a personal casualty loss. So that's another hurdle that we have to get over in order to claim the loss. Now, if it's a trade or business or activity engaged in for profit, we can bypass that and we can deduct those losses where the activity is reported. So there's a more favorable tax treatment. I get a lot of questions about the so-called qualified disasters. So it's very important to realize that qualified disasters, which get special treatment historically, they only reduce each loss by $500, and you can reduce it and take the loss even if they don't itemize. Congress has to declare something a qualified disaster. It's a special legislative grace declared by Congress. So if Congress doesn't pass a law saying Hurricane X or Storm Y is a qualified loss, it isn't. So every disaster gets the standard code provisions unless Congress passes a law giving a different treatment to that loss. Now, what I'm about to say, just FYI, apparently there is going to be a disaster relief bill heard by Congress in the next couple of weeks to provide funding for all of the disasters this year. And Senator Wyden of Senate Finance has said he's making a priority to provide disaster tax relief in that bill. And some of the disaster tax relief may including some past disasters as qualified disasters. But again, Congress has to pass a bill in order to name something a qualified disaster. The IRS has no authority to do that. Now, if a loss occurs in the disaster area attributed to the disaster, there's another thing they can do, which is elect to claim the loss in the tax year immediately before the tax year in which the disaster occurred. So they can amend to get the money faster or the refund faster by amending the prior year. Or maybe the loss has a greater value in the prior year. So it has to be made on an original or amended return for the prior year on Section D of Form 4864. So that's where you make the election. It can be made no later than 6 months after the unextended due date of the disaster year return. So it is time limited. You can also revoke it on or before 90 days after the due date for making the election. And here's the important part. You have to file returns consistent with the election. So you have to file them in the proper order based on the desired tax year of loss. That is in the regulations. And Cheryl, I think it's time for the fourth poll question.
It is. What is the AGI threshold for deducting casualty losses on Schedule A? 7.5% of AGI, 10% of AGI, or 15% of AGI? And Tom, the correct answer, please.
It's 10% of AGI.
Thank you.
We'll do a quick example and then cover a couple of other topics. Marna's car was in Hawaii at the time of the disaster. It was destroyed. It had a fair market value of $32,000 and an adjusted basis of $46,000 at the time. We're going to assume there was no salvage value and there was no insurance compensation since she didn't have comprehensive insurance coverage. The casualty loss is $32,000. It's the lesser of the fair market value decrease versus the adjusted basis. So the Schedule A deduction will actually be $21,900. So the reason is she had $100,000 in wage income. So we have to reduce it by the $100 and the 10% of AGI. Now, she also could have elected to claim the loss on her 22 returns by filing an amended return for that year. So Marna will ultimately claim the loss, and then the amount over the standard deduction will be an additional loss. So you can see how the need to itemize is an additional barrier to claiming her full loss. All right, a couple of additional tax considerations before we wrap up and get to your questions. And there are some good questions I saw in the chat. So Section 139 says that individuals do not have to include in income so-called qualified disaster relief payments. So if someone gets financial relief due to a disaster, they don't have to include that in income. That could be a payment by a business to its employees, as long as it's not a substitute for compensation. It could be a payment by a state or local government. Now, again, the payments can be to help with personal family living expenses, funeral expenses, repair and rehabilitation of a house, contents of the house, etc. So there's a couple of additional information in the materials on that as well. But just remember that a business can give tax-free support to its employees in a disaster. We just have to make sure it's not substituted compensation. Then we have involuntary conversion, gain deferrals under Section 1033. And we're just going to briefly touch on it. But if a property is destroyed or involuntarily converted, what 1033 says is you generally don't have to recognize gain, and then the basis in the original property transfers to the new property. Now, if there's an involuntary conversion and you receive money or unsimilar property, you have gain, but you have 2 years generally to get a similar replacement property to avoid the gain recognition. Now, if the principal residence or any of its contents are in a disaster area and there's an involuntary conversion due to the disaster, you actually get 4 years instead of 2 years. Now, the other thing to consider with this is if you do have gain because you can't defer it under 1033 for whatever reason, the involuntary conversion is disposal of the property. And if it's your primary or principal residence, you can take the 121 exclusion potentially to offset some or all of that gain if you don't get your 1033 deferral. And then quickly, I just want to talk about estimated tax penalties. Now, there is no reasonable cause abatement for the estimated tax payment penalty, but the IRS can waive the penalty. There's a waiver process. And you'll notice it specifically says the imposition is against equity and good conscience due to ... casualty or disaster. So you absolutely can get a waiver of this penalty if you are in a disaster zone, if you request it. Now, of course, most taxpayers have a postponement of when they have to pay the estimates due to the disaster. But if they can't ultimately pay that because of the disaster, they could ask for a waiver due to the disaster. And Cheryl, I think it's wrap up before questions.
It is wrap up, and that was excellent. There's good information in there for all of us with all the things happening in our world. We have 2 remaining live webinar events. That's our update series, which you will find on the week, a very busy week, Tom. They're 4-hour events on Tuesday the 10th and Thursday the 12th. And because they are 4-hour events, we will begin at 1 p.m. Eastern. We thank you for attending. Thank you all.
Thank you all.